Welcome to Safe Simple Sound Podcast. I am your host, PK. Today we have an exciting episode lined up where we use AI voices to bring insightful discussions to life. But before we dive in, please note this podcast is for entertainment and educational purposes only and does not constitute financial, legal, or professional advice. Investment decisions should always consider your personal circumstances, financial goals, and risk tolerance. Be sure to consult a qualified financial professional before making any investment decisions. If you would like personalized guidance, you can reach out to me at savesimplesound.com/contact. Now, let's get started.
Hi, everyone. This is Alex. Welcome back to Safe Simple Sound. Today, we're diving deep into the sometimes daunting, but ultimately empowering world of taxes, specifically Form 1040. This episode is based on a fantastic beginner's guide to Form 1040 on simplesound.com website, and it's packed with practical insights to help you seize financial control, one of our core secured principles here at Safe Simple Sound. This guide provides a comprehensive overview of Form 1040, highlighting key concepts like income reporting, deductions, credits, and of course, how to avoid those common tax filing pitfalls. We'll be exploring how these concepts translate into real-life scenarios, because as we believe at Safe Simple Sound, understanding financial choices is crucial for making informed decisions. Please note that all tax amounts, thresholds, and deduction values mentioned in this guide are examples only. Tax numbers change annually, and you must use the current official values from irs.gov when preparing your actual tax returns. So, how will we navigate this tax terrain today? First, we'll establish a solid foundation with understanding Form 1040 basics, walking through what it is, who needs to file, and looking at the first-time filer experience, as well as the nuances of filing jointly as a dual-income household. This aligns perfectly with our Embrace Mastery of Cash Flow principle, as understanding your tax return is a vital part of managing your finances. Next, we'll move on to income reporting and adjustments. Here, we'll tackle the complexities of reporting multiple income streams for freelancers, and we'll also address the specific tax considerations for retirees with pensions and Social Security benefits. We'll be focusing on how to create a financial safety net, especially important during retirement. Finally, we'll wrap up with deductions, credits, and payments. This section explores the often overlooked benefits available, like childcare credits for single parents and mortgage interest deductions for homeowners. It's all about reaping the benefits where you can, right? So get ready for a practical, information-packed episode designed to demystify Form 1040 and help you navigate the tax season with confidence. Let's dive in. Let's start with the scenario of a recent college grad starting their first full-time job. This is a big step, not just career-wise, but also in terms of financial independence, and that includes navigating taxes on your own for the first time.
Definitely a big change. I remember my first post-college tax season. It was a little intimidating. Suddenly there was student loan interest to consider, and the whole process felt more complex than just dealing with my part-time job's W-2.
Absolutely. And to understand that complexity, we need to look at the Form 1040, the core of your federal income tax return. Sam, could you tell us what essential documents our recent grad needs to gather before tackling the 1040?
Sure, Alex. For someone in this situation, the most important document will be the W-2 from their employer. This form details their annual earnings and how much tax was withheld. They'll also need any 1098-E forms, which show the amount of student loan interest they paid during the year. Those are the key ones for this scenario, although as their financial life gets more complex, they might have other documents like 1099s for investment income or other types of income.
So if I understand correctly, the W-2 shows what I earned and what's already been taken out for taxes, and the 1098-E is for the student loan interest. Does student loan interest count as a deduction?
Precisely. Student loan interest is what's called an above-the-line deduction, meaning it reduces your adjusted gross income AGI. Lowering your AGI can have a ripple effect, making you eligible for other tax benefits.
Excellent point, Sam. That brings us to our next question. How does our grad decide between the standard deduction and itemizing? It seems like itemizing would be necessary to deduct the student loan interest.
That's a common misconception. You don't need to itemize to claim the student loan interest deduction. It's an above-the-line deduction, as I mentioned. So it's taken before you even get to the standard deduction versus itemizing decision. Whether you itemize depends on whether your total itemized deductions, which could include things like certain medical expenses or charitable contributions, exceed the standard deduction amount.
Okay, that makes sense. So even with just student loan interest, I can take the standard deduction if it's greater than my itemized deductions, and I still get the benefit of the student loan interest deduction. So how does understanding all of this about Form 1040 and deductions help me make better financial decisions?
Great question, Taylor. It empowers you to be proactive. For example, knowing about the student loan interest deduction can influence your repayment strategy. You might decide to prioritize paying down other debts if the tax benefit of the student loan interest makes it more advantageous to keep it around a bit longer. Understanding your tax situation also helps you accurately adjust your withholding so you aren't surprised with a large tax bill or a smaller than expected refund. Let's recap. For a recent grad filing taxes, the crucial documents are the W-2 from their employer and the 1098-E for student loan interest. Student loan interest is an above-the-line deduction, and you need to compare the standard deduction versus your total itemized deductions to determine which is more beneficial. I highly recommend exploring online resources. The IRS website has a wealth of information, and various tax software programs can guide you through your first filing. Don't be afraid to reach out to a professional if you feel overwhelmed. So Taylor, we've just walked through the basics of Form 1040 and how a recent grad navigating their first tax season can approach it. Now let's shift gears and look at a slightly more complex scenario, a married couple filing jointly. In this segment, we're focusing on a married couple, both working professionals, who have income from various sources, W-2s from their jobs, investments, and even a rental property. They want to understand the ins and outs of filing jointly, including the benefits, potential drawbacks, and how to report their diverse income streams. Let's start with the big question, Sam. What are the advantages and disadvantages of filing jointly versus separately?
Filing jointly often results in a lower overall tax bill due to combined deductions and credits. Think of the standard deduction. It's significantly higher for married couples filing jointly. This year, it's $27,700, as mentioned in our reference article. If they filed separately, each would only get $13,850. There are also certain credits, like the Earned Income Tax Credit, that are only available to those filing jointly. However, filing jointly also means you're both responsible for the entire tax return. If one spouse underreports income or makes a mistake, both are liable.
So if I understand correctly, filing jointly is usually better financially, but there's also shared responsibility. That makes sense. What if one spouse has a significantly lower income? Does it still make sense to file jointly?
That's a great question, Taylor. Even with a disparity in income, filing jointly is often still advantageous. The combined deductions and access to certain credits can outweigh the impact of the higher earner's tax bracket. However, there are specific situations, like substantial medical expenses or student loan debt tied to the lower earning spouse, where filing separately might be more beneficial.
Let's move on to their rental property income. How do they report that on Form 1040, Sam?
Rental income and expenses are reported on Schedule E, which is attached to Form 1040. They'll report the gross rental income and deduct allowable expenses like mortgage interest, property taxes, repairs, and depreciation. It's important to keep accurate records of all income and expenses related to the rental property.
So it seems like keeping thorough records is crucial for any income source, but particularly important for something like rental income with multiple deductible expenses.
Absolutely, Taylor. And finally, Sam, what are some common tax mistakes couples should avoid when filing jointly?
A common mistake is forgetting to sign and date the return. Both spouses need to sign. Another is incorrect bank information for direct deposit refunds, which can cause significant delays. Also, ensure all income is reported, even if it's not on a W-2, for example, income from side hustles or investments.
So if one spouse forgets to report income from a side gig, even if it's a small amount, it affects the entire return and both spouses are responsible.
Exactly. Transparency and communication between spouses are key to avoiding issues.
So to recap, filing jointly often offers tax advantages through combined deductions and credits, but it comes with shared responsibility. Reporting rental income requires meticulous record keeping and the use of Schedule E. And accuracy in reporting all income and ensuring both spouses sign the return are crucial for a smooth filing process. Before we move on, I want to emphasize that while we've covered some key aspects of filing jointly, every couple's situation is unique. Consulting a tax advisor is highly recommended to determine the best filing strategy for your specific financial circumstances. So, we've just explored the ins and outs of filing jointly as a married couple. That touched on W-2 income and even some investment income, which is a great segue into our next scenario, focusing on a freelancer juggling multiple income streams. Think of a freelance writer, someone who receives several 1099 NEC forms from different clients throughout the year. Taylor, this might resonate with you as you're exploring different avenues in your career.
Absolutely, Alex. This is super relevant. A friend of mine just started freelancing, and she's totally overwhelmed by the idea of managing all those 1099s. She's used to the simplicity of a single W-2.
Exactly. It's a different ballgame. Sam, let's dive in. How does a freelancer accurately report income from multiple 1099 NEC forms?
It's simpler than it might seem at first. Each 1099 NEC represents income from a different client. You'll report the total from box 1 of each 1099 NEC on Schedule C of Form 1040. It's essentially adding them up to show your gross income from freelancing.
So if I understand correctly, even if I get 10 1099 NECs, I don't file 10 separate things. It all goes on to one Schedule C.
Precisely. Schedule C is where you consolidate all your freelance income and related expenses.
Which brings us to our next question. What are some common business expenses freelancers can deduct? Sam?
There's a range of deductions available. Think about the costs directly related to your work. For our writer example, this could be software subscriptions, internet access, a portion of home office expenses if they have a dedicated workspace, professional development courses, even marketing materials.
This could make a big difference for freelancers. So if I buy a new laptop solely for my writing work, can I deduct the whole cost?
Great question, Taylor. Large purchases like laptops are usually depreciated, meaning you deduct a portion of the cost each year over its useful life. However, there might be options for immediate expensing, depending on the asset and current tax laws. So it's always best to consult a tax professional.
Let's not forget about estimated taxes. Sam, how does that work for the self-employed?
Unlike employees who have taxes withheld from each paycheck, freelancers are responsible for paying their taxes throughout the year, usually quarterly. These are called estimated tax payments.
How do you know how much to pay each quarter? That seems tricky.
It's based on your estimated income for the year. You can use the previous year's tax return as a starting point, adjust for any anticipated changes, and divide the estimated tax liability into 4 equal payments. There are also online calculators and resources available to help with this.
Right? And underestimating can lead to penalties, so it's important to get this right. So we've covered how to report 1099 NE income on Schedule C, explored deductible business expenses, and touched on the importance of estimated taxes for freelancers. Before we move on to our next scenario about retirees, it's crucial for freelancers to maintain meticulous records of all income and expenses. Consider using accounting software. It can be a lifesaver. This will simplify tax preparation and ensure you're maximizing your deductions. So Taylor, we just explored the complexities of reporting 1099 income for freelancers. Now, let's shift gears and talk about another important group, retirees, specifically those receiving pension and Social Security benefits. Imagine you're enjoying your well-deserved retirement, supported by your pension and Social Security checks. But how do these payments factor into your taxes? That's what we'll unpack today with our expert, Sam. Sam, let's start with the basics. How are pension distributions and Social Security benefits taxed?
Good question, Alex. Pension distributions are generally taxed as ordinary income. Think of it like the salary you received while working. Social Security, however, is a bit more nuanced. Depending on your combined income, up to 85% of your Social Security benefits may be taxable.
Combined income. What does that include?
Combined income includes your adjusted gross income, non-taxable interest, and 1/2 of your Social Security benefits. The IRS has specific thresholds to determine how much, if any, of your Social Security is taxable.
Taylor, this might connect to what we discussed about AGI earlier. Any thoughts?
Right. We talked about AGI being important for determining eligibility for other tax benefits. So if deductions lower your AGI, they could also impact how much of your Social Security is taxable, right?
Exactly. And yes, there are deductions specifically beneficial to retirees. For example, medical expenses exceeding a certain percentage of your AGI can be deductible. Also, if you're over 70 and a half and make charitable contributions directly from your IRA, those distributions aren't included in your AGI. This is known as a qualified charitable distribution, or QCD.
That QCD is a fantastic point, Sam. It's a great way to support your favorite charities while potentially lowering your tax burden. So if I'm nearing retirement, how can I start planning for these tax implications?
Start by estimating your retirement income from all sources. Then familiarize yourself with the IRS rules regarding pension and Social Security taxation. A simple example is understanding the combined income calculation. A more complex example might involve strategically timing withdrawals from retirement accounts to manage your AGI. And please don't just assume all your retirement income is tax-free.
This reminds me of what we discussed about tax-advantaged retirement accounts in previous episodes. Contributing to these accounts during your working years can help reduce your current taxable income and potentially lower your future tax burden in retirement, right?
Precisely.
So, to recap, pension distributions are typically taxed as ordinary income, while Social Security taxation depends on your combined income. Several deductions can benefit retirees, including deductions for medical expenses and QCDs from IRAs.
And planning ahead by estimating retirement income and understanding relevant tax rules is crucial.
Absolutely. To optimize your tax strategy in retirement, we highly recommend consulting with a qualified financial advisor. They can help you navigate these complexities and create a personalized plan. Now, let's broaden our discussion beyond retirement and explore deductions, credits, and payments more generally. Specifically, let's consider a single parent with childcare expenses. Now, we're focusing on the single parent working full-time who incurs significant childcare expenses. Taylor, imagine you're a single parent juggling work and childcare. What are some of the first questions that come to mind regarding potential tax relief?
Well, childcare is a huge expense. My first question would definitely be, are there any tax credits I can take advantage of to offset those costs? I've heard of the Child and Dependent Care Credit, but I'm not sure how it works or if I even qualify.
That's a great starting point, Taylor, and a perfect lead-in for Sam. Sam, can you explain the eligibility requirements for the Child and Dependent Care Credit?
Certainly. The Child and Dependent Care Credit is designed to help working parents or guardians offset the cost of care for qualifying individuals so they can work or look for work. To be eligible, the care must be for a qualifying child under age 13 or a spouse or other dependent who is incapable of self-care. The expenses must be necessary for you to either work or look for work.
So if I understand correctly, if my child is 14, I wouldn't qualify.
That's correct. The child must be under 13 when the care was provided.
That's an important age limit to remember. Now, let's say Taylor's child is under 13. What's the next step in figuring out if she qualifies for the credit?
You'll need to have earned income during the year. The amount of the credit is a percentage of your expenses up to a certain limit, and that percentage depends on your adjusted gross income.
This reminds me of what we talked about in the earlier segment about AGI. So the lower my AGI, the higher the percentage of expenses I can claim, right?
Exactly. The maximum amount of expenses you can use to calculate the credit is $3,000 for one qualifying individual or $6,000 for two or more.
Okay, let's say Taylor has 2 qualifying children and spends $5,000 on childcare. How would she actually calculate and claim the credit on Form 1040?
She'd use Form 2441, Child and Dependent Care Expenses. On this form, she'd report her total expenses, her earned income, and the AGI. The form will guide her through the calculation, and the resulting credit amount gets transferred to Form 1040.
So, aside from the child and dependent care credit, are there other tax benefits specifically for single parents?
Yes, a single parent might qualify for head of household filing status, which offers a larger standard deduction than the single filing status. They might also qualify for the earned income tax credit, depending on their income and number of children.
That's a great point, Sam. Choosing the right filing status can have a big impact. So, to recap, we've covered the child and dependent care credit, highlighting the age limit for qualifying children, the earned income requirement, and how the credit is calculated. We also touched on the head of household filing status and the earned income tax credit as additional potential benefits for single parents. In our next segment, we'll be diving into the world of homeowners and mortgage interest. In the meantime, we encourage all our listeners, especially single parents, to research the tax credits and benefits available to you. Keep thorough records of your expenses and consult a tax professional if you have any questions. Taking advantage of these benefits can make a real difference in your financial well-being. Imagine you've just bought your first home. Congratulations! It's a big step, and naturally, you want to take advantage of every possible tax break. One of the most talked about deductions is for mortgage interest and property taxes. But it's not always as simple as it sounds. Taylor, many new homeowners might be wondering, what are the limitations on deducting mortgage interest and property taxes?
That's a great question, Alex. I remember from our earlier discussion about Form 1040 that deductions can reduce your taxable income. This reminds me of the above-the-line deductions we discussed, like student loan interest. But mortgage interest seems different somehow. So, does this mean everyone with a mortgage gets a big deduction?
Not quite, Taylor. While mortgage interest can be a significant deduction, there are limitations. For mortgages taken out after December 15, 2017, you can only deduct the interest on the first $750,000 of debt, or $375,000 if married filing separately. So if you have a jumbo loan, you won't be able to deduct the interest on the entire amount. Also, this only applies to what's considered acquisition debt, meaning the money you borrowed to buy, build, or substantially improve your primary home or a second home.
Okay, so a limit on the loan amount. What about property taxes? Any catches there?
Yes, there's a combined $10,000 limit, or $5,000 if married, filing separately for state and local taxes, SALT, that you can deduct. And this includes property taxes along with state income or sales taxes.
So, if I understand correctly, Sam, even if I pay more than $10,000 in property taxes, I can only deduct $10,000 combined with other state and local taxes.
Precisely. These limits were introduced with the 2017 Tax Cuts and Jobs Act.
Our second question was how to report these deductions on Form 1040. Can you walk us through that, Sam?
If you choose to itemize, you'll use Schedule A Form 1040, Itemized Deductions. You'll report your mortgage interest on line 8A and your property taxes on line 5B. Make sure you have your Form 1098, mortgage interest statement, and your property tax statements handy.
That makes sense. It sounds like keeping good records is crucial, just like we discussed with the freelancer scenario. And this brings us to the last question. Is itemizing always better? When does it make sense to take the standard deduction instead?
Excellent question, Taylor. The standard deduction is a fixed amount that reduces your taxable income. You don't need to track individual expenses. Whether itemizing is better depends on whether your total itemized deductions, including things like mortgage interest, property taxes, charitable contributions, and medical expenses, exceed the standard deduction amount for your filing status.
To illustrate this, let's say the standard deduction for a married couple is $27,700. If their itemized deductions, including mortgage interest and property taxes, only add up to $20,000, they'd be better off taking the standard deduction.
So it's really a comparison game. You have to weigh the standard deduction against the potential benefits of itemizing based on your individual circumstances.
Exactly, Taylor. Today we've learned about the limitations on deducting mortgage interest and property taxes, how to report these on Schedule A of Form 1040, and the crucial decision between itemizing and taking the standard deduction. The key takeaway here is to do the math. Compare the standard deduction to your potential itemized deductions to choose the most beneficial option. Don't just assume one is automatically better than the other. And that wraps up our deep dive into the world of Form 1040. We covered a lot of ground today, from understanding the basics of this crucial tax form, just like the article highlighted, to exploring real-life scenarios, touching upon income reporting, deductions, credits, and those pesky payments. Remember those key takeaways. Form 1040 is your form. Those tax documents are essential, and deductions and credits are your friends. I think the discussion around the freelancer with multiple income streams and the retiree navigating pensions and Social Security were especially insightful. It really brought home the importance of understanding your individual tax situation and how it fits into your overall financial picture, aligning perfectly with our C's financial control and embrace mastery of cash flow principles. A huge thank you for spending your time with us here at Safe Simple Sound. Your listenership truly means the world. If you found today's Form 1040 overview valuable, I've got exciting news for you. We're launching Safe Simple Sound Tax Edition, a specialized show where we'll dive deeper into all the tax topics we touched on today. Starting tomorrow, Tax Edition kicks off with a deep dive into more 1040 related topics. If you're ready to master your taxes, just search for Safe Simple Sound Tax Edition wherever you get your podcasts. Meanwhile, next week on our main show, we'll explore estate planning topics. You won't want to miss it. Be sure to check out the show notes for links to all the resources we mentioned, and if you found this episode valuable, please leave a review and share it with a friend. Remember, sharing is caring, and financial empowerment is something we should all embrace. This is Alex, reminding you to keep it safe, keep it simple, and keep it sound.
That's all for this episode. If you found it valuable, don't forget to subscribe to the podcast. For more insights, you can join my newsletter at safesimplesound.com. If you would like personalized guidance, you can reach out to us at safesimplesound.com/contact. Until next time, take care and bye for now.